So welcome everyone. This is the first session in March. I can't believe that we already are in March. So happy March to everyone. In the Boston area, we still have a lot of snow. And I was telling Jacob earlier that we are completely covered with snow. The weather hasn't warmed up yet to see the grass and the greenery. So I think the Pasquatani Phil's predictions has come out really, really well. The groundhog is never wrong in these things. So 10 more weeks of winter is what we heard in February. And lo and behold, we are kind of, still in the midst of winter, which makes it even interesting because, we have the warmth of our GPUs and the clusters and all the machines which are cranking out machine learning and data science models. And we can sit in the comfort of our homes and get our cup of tea or coffee or whatever we like, and we can start coding all these fun algorithms. So in the spirit of making sure that we can continue learning and sharing, I really appreciate Jacob, you taking off time of your busy schedule and making time for us. So this is the QuantUniversity Machine Learning School, and as part of the guest lecture series, we've been hosting eminent speakers, researchers, academics, and every week we invite a specific discussion on a specific topic, and we invite speakers who are more or less kind of, doing this 80, 90 hours a week, making sure that machine learning algorithms and data science algorithms are adopted responsibly within the enterprise. And Jacob and I, we have known each other for many, many years. We have attended many conferences together. We have spoken on many panels together. And I really respect the initiatives Jacob has taken within RegentSpank. And in the context of, not only making sure that artificial intelligence and machine learning is used in an innovative way, and they've had a lot of innovative projects within the organization, but also they're kind of factoring in the responsible aspects of it. And Jacob and I, we have spirited discussions on our LinkedIn discussions on what is fairness mean, what does bias mean, what does explainability mean, what regulatory aspects should we be seeing as we adopt these principles into practice, and also kind of sharing our knowledge, because as you know, many of the programs we have at QuantUniversity is geared towards professionals who are not only interested in adopting technology, but also kind of looking at the big picture. What does it mean for responsible adoption of these technologies? So welcome, Jacob. This has been an absolute pleasure. And I'm just gonna, do a couple of introductory housekeeping items. So this program, as you know, is brought by QuantUniversity, and QuantUniversity, if you are new to it, is an advisory. We're based out of Boston, and we run educational workshops and also do a lot of consulting services in the context of machine learning and artificial intelligence risk primarily. And we have a certificate program which we launched in partnership with Premier. It factors in multiple courses so that you can gear up towards not only understanding the concepts of machine learning, but also adopt it responsibly through looking at what does model risk management mean, what does stress testing and scenario testing mean for model risk for machine learning models, and also what is this whole area of algorithmic auditing. So as the opening of the post-COVID era happens, we are offering multiple options. We have an online mode, we have a hybrid mode, and also we are going to be offering live workshops, and it could be joined anywhere from the globe. And the first workshop is on March 21st, and we're going to be having the Just Enough Python for Data Science on March 21st. On April 25th, we have the Machine Learning and AI for Financial Professionals. On May 23rd, we have the Model Risk Management for Machine Learning Models. June 27th, Stress Testing, Scenario Testing for Machine Learning Models. And on July 30th, algorithmic auditing for machine learning models. So here's your opportunity for spending 5 months of intense coaching and learning on what does it mean to do AI risk management. So I welcome you to check out our programs. That way you will be, as a part of the QuantUniversity community, you will be able to see what's actually happening in the practitioner's world and adopt the best practices. And every week we are going to be inviting speakers, so you'll be able to collectively learn from the expertise of various audiences. So that's a little bit about on the programming side. Now, as you all know, we have been hosting these workshops over the past year or two. And we have had like more than 50 lectures as a part of this whole series. And Jacob has presented at our guest lecture series last year. And today we are going to look at this whole area of what does data science mean, especially when you're looking at a regulated space like financial services industry. And as you know, there is no one simple way of saying what data science is, because there's a combination of data and various products, and you had to build out like pipelines using GPUs and Spark and TensorFlow and many other microservices based applications. But also you got to factor in not only the operational efficiency aspects of it, you have to make sure that you're taking care of your fiduciary responsibilities, your regulatory aspects. So there is a whole holistic picture which needs to be thought about in the context of AI and machine learning governance. And Jacob has been leading these initiatives for many, many years. And he's been at Regents since May of 2014. And he has also served as on the Alabama Commission of Artificial Intelligence and Associated Technologies. And he has been nominated by Regents Bank and selected by the Birmingham Business Journal as a top 40 under 40 professionals. I think we talked about this last time, Jacob. You don't look 40 yet. So Jacob has 16 years of experience in the financial services industry, including model development, model risk management, and credit review, all favorite topics of mine. And prior to Regents, Jacob served multiple roles at PNC, the Freddie Mac, and Genesis Analytics. So welcome, Jacob, for making time for us, and the stage is yours.
Well, great. Thank you, Sri. I really feel valued and happy to be here. Thank you again for the invitation, and happy to come regularly. First, the views I'm going to express today are my views and not necessarily those of Regions Financial. And I'm going to walk through a variety of topics today. And definitely, if you have questions, feel free to work through Sri to follow up with those questions for me, or you can put them in the chat function, and I'd be happy to address those questions. Okay. And by the way, so I'm taking this call not from my normal office. My regular office is in Birmingham, Alabama, where Regions is located, but rather about 20% of my team is based here in Atlanta, and about 20 to 25% of the Regions quantitative community is in Atlanta. So I do come out here regularly, and I have an office here in Atlanta. So I'm actually taking the call from the Regions Plaza in Midtown Atlanta, and it's quite nice out today. So I'll start sharing my screen to walk you through the materials. All right, can everyone see my screen okay? All right, great.
Yes.
Perfect. So first, we'll talk through the different methodologies. So in the financial services industry, you've seen a growth in the sophistication of modeling, right? And most modeling is used to either increase revenue or decrease costs. There are other uses as well we can talk through. But when we think about modeling in the financial services industry, we want more accurate underwriting models. So we can, customers that previously we declined that would have been profitable for us to lend to, how can we improve our modeling so we can make those loans and ultimately increase profitability at the bank and provide more credit to customers? Relatedly, there are, same thing, say there are fraud models. They're designed to protect the bank from losses, from fraud losses. There's also a growth of models that are used to replace manual processes. Then, of course, there are models that are used for a variety of other purposes, anti-money laundering indications. There's ones used for capital planning. There's market risk models, a lot of capital markets models, a lot of trading models, a lot of valuation models. Banks use models for everything. Obviously, one of the core areas is credit underwriting. So as we see here on slide 2, there has been a general progression in modeling as data has become more available, as more advanced techniques have been developed, as computing power has grown, as availability of data has become increased, and streaming data and banks' appetite to utilize their data more effectively. And with the more advanced models, model risk teams serve in a few functions. One is we have the opportunity to serve as trusted advisors to lines of business, and they're thinking, should I use models? Should I not? How? What risks I worry about? And of course, doing rigorous testing of models. In model risk, when we test models, we really look for three things. So one is their accuracy. Is it being efficient? And is it being fair? Right? So accuracy is big. Efficient, that's where model risk does a lot of work on recommending improved ways the models can run better. And then, of course, how can the models make sure that we're treating all members of our community well and that we're testing our models for any disparate impact to protected classes. So from the data science perspective, if you're sitting in a data science team, how can you build models that meet the line of business's actual needs? How can you meet models that meet your internal expectations? The firm that you work at will have policies and procedures and templates. How do you make sure you're meeting those expectations? So we're going to walk through a lot of that today. One kind of takeaway from slide 2 is we believe often in the modeling community in parsimonious models, right? If you have an option to make a very complex model for a solution or a simpler model, the desire is to use the simpler model, right? There's no extra points by making it more complicated. You don't get extra points from regulators. You don't get extra points from your board. You don't get extra points in the line of business. It's very common for lines of business to say, how does this model work? So if you're building a model to detect fraud, we'll say, well, what's driving it? Is it card present versus card not present? Is it the time they use their they use their card? Is it the time? Is it where they're shopping? Is it where they're located? Is it where they're shopping online versus in person? Is it location? Is it velocity? Is it dollar volume? And it's very important that when you're building models that you really have that in your forefront, that the head of fraud is going to ask you, what's driving this? Or if you're using multiple models, where's the attribution? Which one is helping me better with debit card? Which one's helping me better with fraud? Which one's preventing more international transaction fraud, which is preventing more in-person branch transaction frauds? And so same thing with credit models. Is this credit model for some segments overestimating the fault? Are we taking on strategic risk by declining too many customers? If this model is working better, how much more money could we make? That's a common question you'll hear. If this credit model was working better, how many more loans would we be booking? How much more revenue would we be having? And be able to answer, how much on both sides. If there weren't error X or error Y in the model or limitation X, limitation Y, what segments could you be lending in differently? And when you do reject inference, how much money are we leaving on the table? And as well on the other side is how much credit loss are we taking because of errors from the model. So it's important as you think through various models that you're not taking too much trade-off on any explainability risk or interpretability risk, and that if your bank has a zero appetite for black box models, and also there's a hesitancy to use post hoc explainers, and there really is a desire for more interpretability, just be aware of that as you're progressing in the modeling space. So we'll talk a little bit about maybe what you've seen in the industry in the last few years. So if you go back a few years ago, what do we see? Ongoing monitoring programs are pretty manual, pretty custom. Model development and coding wasn't very standardized. You often saw, unfortunately, examples where model developers did not follow standard expectations on modularization, on source version control, on unit testing, on integration testing, and so forth. Often you had a situation where a lot of modelers grew up out of the capital planning process. They grew up out of the economics world, statistics world, the econometrics world. And they might have, through a reorg or a variety of things, were thrown in a mixture with computer scientists. And so you had these new model development teams, which had economists and statisticians, but also computer scientists. And sometimes the process wasn't as smooth. So now banks still have just as many computer scientists and statisticians and econometricians, but rather there's a focus on how can we learn the best of both worlds? How can we take best practices in the computer science from our computer science associates and from our IT department and train our quantitative associates and our statisticians and our econometricians in that space? And separately, how can we take our computer scientists and have them bring a risk framework to their work, how to bring a risk mindset, how they can learn some of the risks that our econometricians and statisticians have seen. So one thing you've really seen is this improvement on where parties are learning from each other. And now most model risk teams, most model development teams, most data science teams, whether it's a data science team for operations or data science team for credit, you have a mix of computer scientists and economists. You'll probably have about an equal amount of PhD economists as you do PhD or master's computer scientists. You're really seeing firms having a healthy blend. So what did you again see in 2019? Kind of custom or manual ongoing monitoring, model development that wasn't following technology best practices, documentation that was manual, and significant change that required material manual steps. So what are you seeing at banks today? Today, you're seeing monitoring programs are templated, usually they're automated, can be aggregated. So it's very simple today for in our building, our head of the consumer bank's 2 floors above me visiting. And so when you think about the consumer bank, the leader, he or she can go to one dashboard and see, how are my collection models doing? How are my home equity models doing? How are my mortgage models doing? Credit models doing? And you have to figure out the appetite of the executive. Does the executive know what PSI is or AUC or KS? If they don't put that in your performance monitoring, or put that in a different aspect that'll go to different parties. But if they want to, if back testing is more relevant to them and saying, hey, look, this model for this cohort, we predict that 6% will default. So every 1,000 loans, we think 60 will default. Only 20 defaulted. Man, we are overestimating the default. We left a lot of cash on the table. But for this other cohort, where we thought there'll be a 1% default within 36 months of origination, so we thought of 1,000 loans, we'd have 10 default. 25 defaulted out of these 1,000. And I think that's important when you think through ongoing monitoring. There's ongoing monitoring. You really have to think who's the reader, and you'll have different ongoing monitoring. So, what model risk cares about, and they'll say, oh, is PSI changed? Are the applicant base different than the applicant base the model is built off of? Is the training set very different than the applicants today? Oh, our California was never in our training data set. Now we have applicants from California, Canadian customers who moved to Florida weren't in our training data set, and now we're using the model to lend the snowbirds. There's that conversation that might be with model risk, and maybe with the line of business as well. But with the line of business, maybe it's a different conversation, less about the training data set and more about this segment. We thought 6% would default and 2% defaulted. And on this segment, we thought 1% would default and 3% defaulted. So really do think of ongoing monitoring, how to make it very easy for your leadership to see it and not confusing, not they're saying, I have no idea what this is, I'm going to throw it away. Your ongoing monitoring has to be practical to the executives that are relying on these analytics. The executives might not own models. The models might sit in a risk analytics function or a chief data and analytics function or sit in various functions. But the ultimate customer are the executives and the leaders that don't own models, don't have any quants reporting to them, have no data scientists that are 2 deeps or 5 deeps or 10 deeps to them. But their business, they've made a choice to innovate with data and digital. They've made a choice to move away from manual processes to automated processes. They've chosen to maybe cut back on, fraud analysts and rely more on fraud analytics, cut back on, manual underwriting for consumer credit, and they're doing automated or partially or more and more automated. They want to know, are the models too strict? Are they too lenient? Do they not work here? Do they not work there? And this is where you as a data scientist can really build models that meet their needs, but talk with the leadership, or maybe your boss talks, depends on what level you're at, but talk with the lines of business to understand, are you actually building the model they need? And when I talk about ongoing monitoring, this is an important part. That is the ongoing monitoring, meaning what they're needing. Sometimes there's a stereotype that leadership doesn't care about ongoing monitoring. But for my interactions, leadership, not talking about model risk, I'm talking those that rely on the models, care about ongoing monitoring. I'll hear from the head of the corporate bank, how are our corporate underwriting models doing? How are our corporate risk rating models doing? You hear from the head of operations, how are the fraud models doing? You hear the head of the consumer bank, how are the fraud models doing? How are the underwriting models doing? How are the collection models doing? And so ultimately, when you think of, you have so many stakeholders, but it's important to remember one of your biggest stakeholders are the non-quant, non-data scientists, lines of business that rely on your products. And so I just want to throw that out there. One thing we're seeing also in 2022, again, is better coding practices. Big thank you to your IT departments. What I've seen in the industry is as follows. I would say it this way. You have parties learning from each other. You have data scientists that might have been sitting in operations or technology and not learning best practices from risk, not having model governance programs, not having data governance programs, not understanding SR 11.7. And you had risk partnering with them, teaching them, and they're growing. And equally, you've had data science teams teaching, oh, how do you use Git? I never heard of Git. Oh, what's Bitbucket? Oh, what's TensorFlow? Oh, what's Bamboo? Oh, how do you orchestrate? Oh, I didn't know what pipeline development meant. Oh, what's Python? And so you have risk groups learning as well. And so obviously there's some people that are unicorns and have it all. But what I've really seen beautifully in the industry is IT departments learning from risk and risk learning from IT departments. And sometimes there's reorg, sometimes it's just learning, but that's really been a beautiful thing that if you're at a firm where that's happening, keep learning from each other. It's the old saying, who is a wise man? One who learns from all others. So keep that up. There's some items on data as well. So when you think about knowledge for your own career, you don't need to have every single skill. You don't need to be a unicorn, but as a team, you need to have all these skills. So when you think about what I'm showing here on slide 4, our team needs banking knowledge. So we're building practical models. Say you're running a data science department or you're a model development executive. That your team understands the needs, whether it's fraud or it's capital markets or it's operations or it's loan valuation or it's the trading book or it's CMBS warehousing, whatever it is. Do you know the banking processes? Do you have programming skills? And do you have math and stats? And so these are items to kind of keep in mind that as you work through even if as an individual you don't have them all, hopefully in your team of 3 or 4 people or whatever it is has this. And there's a variety of ways to structure teams. And then there's always the trade-offs. Do you want to become pointy, meaning you're already pretty good at one of these, do you want to get even better, or do you want to become well-rounded? And so I think there, just talk with your mentor and talk with your manager about the best path there if you should become well-rounded or more pointy. So this is just a simple flow of how modeling looks at most banks today. So hopefully this isn't too surprising. Usually you get a data snapshot or you point to an immutable data set. You have your data, then usually do some exploratory data analysis, some model training. That data usually goes back into the data lake. You have Jupyter Notebook and other Markdown, other ways to keep track of you're commenting on your code, and you're commenting on it. You write a function, you build monitoring, there's some testing, some reporting, and then hopefully you're moving away from Microsoft Word and you're using a variety of automated documentation platforms. Confluence, there's a variety of vendors that provide this. So that's a process that I would say is evolving. And I have a second view to make it's the same picture, just a slightly different lens, showing where the data flows in orange, how production works at most banks these days, and how monitoring works at most banks these days. This is just the 3 pipeline view. So in short, when we think of the model risk side, we test implementation as much as we test conceptual soundness, right? We test data quality as much as we test ongoing monitoring. That there's aspects when you're building a model and when you're validating a model, what they care about. With us, we have 6 work papers or 6 areas in model risk. 1 is model use, 2 is 2 is conceptual soundness, variable selection, segmentation, theory and developmental evidence. 3rd is data. So data quality, data veracity, data timeliness, data appropriateness, transformation of data. 4th is model implementation. 5th is model performance, as well as either errors in model performance metric calculations. That's big. The metrics used to calculate a model's performance, are those metrics accurate, or are they inappropriate, or someone just have an arithmetic error in them, which unfortunately can happen a lot. And then 6, kind of model governance. So these are some views on model pipelines. I guess I could pause 3 if there's any questions at this point.
Yeah, I think there are a couple of questions in here.
Yeah.
One was with respect to, I think, your second slide, which is the tiering. How do you assign the tiering for your models?
Yeah, that's a great question. So the underlying word I would say is uncertainty. Mm-hmm. That as you go from tier 1 to tier 2 to tier 3, you're increasing more uncertainty in the model. Usually, this is a generalization. Another word you could use is complexity. So one is that, do the model developers know what they're doing? This is pretty hard stuff. This is why Sri is getting a lot of customers for his business. As you go into tier 3, 4, 5, and 6, this is hard stuff. So there's going to be some complexity. There's more risk for error. There could be, hopefully at your institution, you're really committed to interpretability, but at some institutions they're not so as much. So you're going to run into more interpretability problems as you move down into the higher tiers. So ultimately you're bringing more risk to the bank related to uncertainty, potential errors, potentially not knowing about the errors, potential disparate impact of protected classes. When you're building a simple regression model for underwriting and there's 20 variables, it's pretty easy. When you're having a underwriting model with 1,000 features, it can be a little harder on explainability. And then thinking, okay, well, I found someone using their ATM from 3 to 4 in the morning is correlated with default. Let's use that. Well, you're bringing some reputation risk. Looks like you're maybe discriminating against, healthcare workers or firefighters who have to, are doing, helping society during, the middle of the night, and they're stopping the ATM. So you have to be very sensitive as you move down this curve that, are you really understanding the attributes of your model? So that's, and these aren't perfect. This is not designed to be set in stone. A lot of this is just more to think through. But generally, as a tier is higher, we're going to increase the frequency of and the intensity of model risk test work.
Yep, absolutely. And I think we discussed that in the stress testing and scenario testing course too, because there are so many scenarios which may not have made it into the training data. And,
right.
Like these unique use cases. And that's where, you got to, first of all, you talked about uncertainty, but also, the impact or the intensity of, what would happen if model potentially would go wrong, right?
Right.
So I think there's another question.
Yeah.
And we have a fan of yours because, Okan attended your prior workshop too. And he's one of our participants at the QuantUniversity courses. So he has a question. So Jacob talked about the modernization of the MRM framework. In this line of discussion, how does he see the incorporation of model ops into the MRM framework's workflow? What is the industry's current stage about soundly incorporating model ops into model risk management?
Yeah, great question. See what slides I had.
Thank you, Okan, for the question.
Yeah, that's I'm going to go to slide 20. There's different slides I could point to, but slide 20 is probably the best on this one. So in short, yes, there's a variety of vendors in the space that you can definitely talk with. You consider building it internally, but there are ways you can modernize your development process. So let's look at 6 here. And I think you could broadly call this in the model operation space or model ops space. Obviously, there's some difference in definition, but let's call all 6 of these broadly in model ops. And by model ops, I don't mean a specific firm. I mean, there's obviously there's a busy space. All right, development tools. Are you using quick access for data exploration, analysis, development playgrounds for model research? Testing automation, that's I would define as part of model operations. Streamline the replication of model developers' results through standardized work papers. These environments expedite the execution. So you think of model ops, are you creating an environment, and later on a wrapper, but creating an environment where you can build models safely and quickly, and maybe with some automated documentation? And then how does model implementation work? And therefore model ops often plays a large role in how models are ultimately, submitted and deployed. So next is automated report generation. In reality, I'd call that partially automated validation, partially automated report generation. Rapidly populate and publish consistent model development reports in a controlled and reproducible manner. Next is expedite report generation by deploying a centralized report workflow system, incorporating the model's use and the model type with content and template management. Meaning if you're using a model for consumer credit, there's going to be different things you're testing and different things you're reporting than if you're using it for capital markets, or using it for which you're not going to, testing a model for disparate impact of protected classes isn't going to be as relevant into a model on a capital markets model, a derivative model, and so forth. We'll jump to the bottom boxes, standardized bundling of code, input data, test perform, and results into a model package developers can provide to my team, the model risk management. Packaging significantly shortens the time required to align testing. And you can go into this fight. Oh, I sent it to you in an email. No, you didn't. I did. Oh, your email was too big. Oh, I made a share folder. Oh, you can't have access to our share drive. Well, I need to give you stuff. Well, we'll have to put in a request. That'll take a week. Oh, I'll ask for it. Oh, the guy who does the request is on vacation. Like, you want to get away from email. So this helps with some of the model op process. It is important to remember that maybe the automated reports you're making is different for different audiences. Not that you're having different data or different numbers, God forbid, but what the head of the consumer bank wants is 1 page. What model risk wants is 50 pages, and what the credit risk committee wants is 2 pages. But what the consumer credit working group wants is 4 pages. So when you think through what you're producing, what's needed for the head of the consumer bank is 1 page, credit risk committee 2, consumer credit working group 4, consumer credit modeling forum, I don't know if that exists, that's 5 pages, model risk, 80 pages, internal audit, whatever, 43 pages, So do think through when you're producing, what you're producing for different audiences. Next is ongoing monitoring. Again, what the line of business cares about is, so is it working? Is it not? Like, what's going on? If you're just like, well, here's the PSI and here's our KS and here's our AUC, they're going to be like, well, all right, you know what? I have no idea what you're talking about. So, but model risk is going to give you a finding if you don't give them PSI and KS and AUC. So don't not produce it. You produce it, but just be thoughtful who you send what to. So one, the line of business doesn't think you're head in the sky academics, and then model risk doesn't think you don't know any statistics. So you got to know your audiences. So ongoing monitoring, automation, nature, extent, and frequency of monitoring. And then I guess, which some people could even call the last box. When you say model ops, you might have only meant the bottom right box. So deployment tools, automated deployment to production, automated deployment of models that were developed into production. So going from development to production, ability to push changes to production faster, controlled, some people define model ops as literally this last bullet point, controlled deployment pipeline that migrates changes through automated testing prior to production and ultimately final production. So this is the whole broader use of the word model op. Initial development, I'm looking in the middle of the slide here, testing automation, ongoing monitoring, model documentation, partially automated, model submission, model validation, production, with a healthy feedback loop on ongoing monitoring. Hopefully that was helpful.
Oh, this was very much helpful, and you kind of read my mind in terms of many of the aspects in here, Jacob. And I also talk about this notion of a chasm between the governance and the DevOps and the MLOps teams,
right.
Because as you were mentioning, a lot of tooling which is coming from the industry now
right.
focuses on the metrics, but doesn't really convey the next answer, like what does this metrics mean from a decision maker's perspective, right? And you may present all the things in the dashboard which could be intuitive for a data scientist or an MLOps engineer, but probably doesn't make very much sense for someone who is wanting to make decisions, because many people are not the PhDs who are basically also doing the model development, also doing the decision making. So you had a really nice Venn diagram, because you have the context knowledge, like I know my banking industry, I know my customers, I know what the problem is, but trying to bring in that connections of, here's what MLOps can do, but what does it mean from a decision-making perspective, and what does it mean to risk? What does it mean to, adopting it as a best practice within the organization? Yeah.
Exactly.
I think we should continue. I think there are a couple more questions, but we can maybe spend the last few minutes on the questions. I don't want to interrupt you with thought flow. Yeah.
Well, definitely the slides will be available for everybody, so definitely read through. I'm going to skip around here, but there's a lot of good text on here, and of course, feel free to reach out to me afterwards. I'm on LinkedIn. You can message me and I'll message you back, and we can chat. So let's jump to, read data slide 7 in your own time. That's a good one. 8, okay, your artificial intelligence risk management, AI risk management. At some firms, like Regions, AI risk management is a subset of model risk. So model risk has tool inventory, we do validations, annual reviews, we do model finding, testing, remediation, we do AI risk management, and so forth. So this is a general view, and every bank can be different. Slide 8 is not perfect. It's not exhaustive. It's to consider for further conversation. So here we go. So one is process governance. Here's a framework. Here are partners. Here are risks. Conceptual soundness, technology. So when you think through AI risk, for us, AI models are models, and they count as as items that go in our scope. We validate them. Every firm can be different. Different firms can have different approaches, but a common approach is that AI models are models, they're validated. And we think about what is a validation. Is that are you testing fairness? Are you not? Are you testing transparency? Are you not? And so a more mature, robust model risk management program, after model risk does everything, their validation of a machine learning model, there isn't much left that there isn't a supplemental group that needs to do additional AI risk testing. In other groups, model risk has a narrower work set, and then maybe they send it over to compliance to do fairness testing, or they send it over to, data risk to do data privacy testing, or they send it over to IT risk to test if the model's allowed to use open source code, or maybe they send the IT risk on models in the cloud and how models work with APIs, or they send to whoever to do whatever. So, it is important to think through, if you're on the model development side, who's looking at your work and why. Oh, compliance is looking for fairness. IT is looking for, open source libraries. Data is looking for data privacy. So it is important to think through who's looking at your work. But this is a framework that you often see in regions, every firm is different. Some model risk takes on more of this. Some model risk works IT risk takes on stuff, data risk, compliance, especially on open source code, is that IT risk or model risk testing that. These later slides talk through what to focus on when you're building, if you're a data scientist at a large bank, make sure you build a strong monitoring program, make sure you assess alternative designs, meaning simpler designs, compared to a maybe more complex methodology, perform reviews of open source libraries that are new to the bank or not widely accepted or widely adopted, understand where model risk is giving findings. Model risk departments in the industry are identifying findings in a variety of areas. So be aware, learn from others' mistakes. If you're building a model, if you're a data scientist, get access to model validation reports, read model validation reports, talk with people in model risk, become friends with people in model risk, maybe even buy them lunch, and learn what they're looking out for and where their concerns are. And if their concerns are an edge case, are their concerns on open source algorithms, not because it's a pet peeve, but rather it's the opposite. It's because they might see aggregate risk here and saying, man, 5 models in a row, people used open source, algorithms incorrectly. Well, 5 models in a row, I found that we were, sending all this data back to a vendor I didn't think we were. Or 5 models in a row, we had problems with hyperparameters. Or 5 models in a row, I really found, bizarre variables like pet ownership. And that was used for our collection models. And you're like, pet ownership should not be used in a collection model. How come I saw that again? So, it's not that they're pet peeve, it's that you can get to know model risk is that they're touching all these models and you don't want to be that example of like, oh, there goes another person using a variable without a business justification. So it is important to understand where model risk is coming from. And on the previous slide, these are ideas of what you can do well. Demonstrate your subject matter expertise, perform appropriate assessment of data for potential bias. If your firm does that, some firms only like compliance or legal does that. But if your firm allows you to do that as a developer, do assessment for bias in your data, perform hyperparameter sensitivity analysis. Remember that machine learning models can overfit. Quick story. In the industry, if you go back, say 2.5 years, an attribute that for many fraud transaction models were card present to card not present history, meaning if somebody had historically primarily or exclusively, if she or he used their card in person. So I'll tell you the story of my mother. So my mom, her whole life up until about 2 years ago, had never done online shopping. And so 100 transactions in a row, her card's with her, her credit card is with her. So sure enough, in March of 2020, she starts buying groceries online, tools online, home appliances online. She bought an iron online. She bought a washer, a dryer online. She bought tickets like a subscription thing online. And her card got frozen for fraud. So she calls me and she says, Jacob, can you fix this? And I say, well, Mom, I don't really work in the fraud department. I'm in risk management. She's like, I can't use my card. It keeps getting fraud. Can you fix it? This is St. Patrick's Day, 2020. So then I realized, okay, I need to be a good son. I love my mom. So we start looking into the fraud models. Sure enough, what variable is the most predictive? It is card not present. If someone has a card not present transaction, with a history of card not present, he thinks it's fraud. The model was overfit based on pre-COVID conditions. But as we move to a safer at-home, stay-at-home orders, quarantine orders, the world changed. And now legitimate behavior by my mom and hundreds of millions of other customers were called fraudulent. They were false positives. So these models are now being updated. But do have in mind, my mom, in that when you're building these models, behaviors can change because of the market, because of customer behavior, because of macroeconomic conditions, because of pandemics, because of other situations. So be very sensitive of hyperparameters and think of your mothers. All right, I'll pause for more questions with that.
Perfect. So they have a couple of questions. I'm just gonna try and summarize. I think you had the slide with natural language processing, so I'll probably bring up that question first. So Twang, who's also one of our committed workshop participants in the QuantUniversity Model Risk Management Program. So here's a question: are there cases where the tools have AI ML methods but not meet the model definition? For example, chatbot.
Yeah, so for us, I think where we try to spend our time is less about, is it a model, not a model? Is it bringing risk to the firm? And fine, if we don't call it a model, is someone testing it? And maybe it's a model, but it has a low impact. And so we do a lighter testing and we require less documentation and less model owner testing and less ongoing monitoring. Maybe we say, fine, it's not a model, IT test it. I think the bigger issue isn't, is it a model or is it not? Is there the right amount of controls, the right around risk metric, the right risk monitoring of it? So if chatbot says struggles with customers where English is their second language, then there's a bigger question of, do we want to roll out something that only helps one segment of our population, which is customers with English as their primary language or your first language, and it really struggles with customers where English is their second language? Is that something we want to roll out? Is that something we're willing to take on that risk? What's the bank's appetite? And so where model risk, I think, has a good history is pointing out where models don't work well. Hey, that automated valuation model doesn't work well in rural zip codes. Oh, that fraud model doesn't work well with international transactions. Oh, that collection models doesn't work well for customers that don't have deposit relationships with us for credit card collections. Or, model risk is very good at figuring out limitations, or hopefully they are, and say, oh, this model was only built in our 15-state footprint. You want to use it to buy national credit paper? And so I think when you think of chatbots, all right, well, what was in the training data set? Was the population, the language, was the population it was built for applicable to your customer base? Maybe your customer base has, uses certain geographic specific terms. Maybe in certain parts of the rural Southeast, I want to cash a check actually means I want to deposit a check. Meaning when you say, I'm here to cash a check, that doesn't actually mean you want cash back. If you would say, I would like to cash this check, means you actually mean you want to deposit the check. And that could be a southern rural adaptation of cashing the check. And so I do think it's important to, if you don't call it a model, fine. Like, I'm not arguing to call it a model or not a model. I'm just saying recognize the risk and who should be doing it. I'll give you a great example of anti-money laundering models. There's an anti-money laundering model. This is 8 years ago. And where some banks didn't even call anti-money laundering models. They said, oh, it's a decision tree, it's business rules, it's a lookup table, and And that was a share of that, right? Now I think almost everyone calls them anti-money laundering models. But if you go back to 2014, I remember from peer calls in 2014, a third of peers did not call AML models. They called them business rules. Mm-hmm. So a great example came. So a peer was looking at their AML model, and they saw there all this suspicious activity, and therefore suspicious activity reports by the coast. Okay, that makes sense. Oh, they were in the kind of aquatic entertainment field. And what is that? Let me dive in. Oh, it's all these scuba diving firms. They're all being flagged as OFAC violations, actually, as Office of Financial Asset Control. Oh, and then everyone made up these reasons. Oh, well, scuba diving firms are probably money launderers, or they're fronts for drug dealers or other crime. And then we just looked in the model and said, no, the model looks for the word Cuba, C-U-B-A. The word Cuba is in the word scuba. C-U-B-A is part of the word scuba. So, you can really, if you don't dive into the data and do some model risk testing, you can come up with all these reasons and be like, oh yeah, scuba firms, they are super dangerous. They're always laundering money, but they're not. They just happen to have the word Cuba within the word scuba.
You're discriminating against deep divers now.
Seriously, they're people too. So anyway, so I think there's some argument that I want to focus so much on the definition, but focus on, is there good testing going on?
Absolutely. And I think with respect to testing, there's another question. What's the best way to go about doing business process scenario testing before models in combination with rules, which are deployed into production? Yeah.
So I think one thing is to really sit down with the line of business and understand them, how they use the model. And, say it's automobile lending. And for some reason, the model was only built on four-wheel vehicles and people, if they paid back their loans for four-wheel vehicles. And the line of business is like, oh, we're going to use it for motorcycle lending. We're going to be the biggest motorcycle lender in all of America. And that's like your bank strategic plan. It's like your goal. We're going to, by 2030, we're going to have 70% of all motorcycle lending is like your bank's goal, whatever. Well, okay, when you think about this, then step back and with your line of business saying, okay, well, what tools can we have? We didn't build models for motorcycle lending. We've never done motorcycle lending before. So some areas where there isn't that history, or you can't, maybe you can buy the history, but you don't have the internal history, you can actually buy that history. But the line of business say, well, we're going to use some qualitative business rules because this process doesn't have enough history, or we don't have enough history. And so I think it's through a conversation of when modeling will work and when modeling won't work. What about edge cases? And what about, in our example, you've only done four-wheel vehicle loans, and all of a sudden you want to do motorcycle lending. Your model, I have no idea. Maybe motorcycle lenders default at lower or higher rates. I don't know. But that's the whole point. We don't know. And so you'd have to be sensitive. Will your model work? And then if you guess it will, and years later you realize motorcycle lenders, or motorcycle customers, nothing against anyone with motorcycle, but even with the same FICO, default at double the rates, well, that's not going to be a pretty day when that results comes in. So I think really think through in particular, when the training data set is not going to represent the use of the model.
Interesting.
The population the model will be used on. Yeah.
Right. That's, again, I always emphasize context is king. You got to sit with your business users. Otherwise, a developer just focusing on metrics, maybe optimizing for the wrong metrics. Right. So that's always the case. And then another question, for an MRM team operating with legacy approaches and tools, what would you say should be the starting point to modernize across the 6 areas? I think he's referring to slide 20, which you have. Which of these areas should you invest first in? Thank you for your question, Mehdi.
Yeah, got it. So in terms of, that's a great question. So I think is ultimately is to have a heart-to-heart with your model development teams and saying, hey, what are your pain points with model risk? Oh, you're too slow. You're obsessed with documentation. You only care about capital planning. You're always debating stationarity and multicollinearity with us. You don't understand the bank, like whatever their concerns are, hear them. Don't argue, hear them. And if the concerns are there, all right, you hear those concerns. Maybe they're, oh, you can't handle new models. You don't know SAT. You only know Python. You don't know newer techniques. You can't handle this. or your program was built for CCAR and now CCAR is only 12% of our models. So really hear what their concerns are and step back and say, how can I address these concerns while still providing rigorous risk management for models? Are there areas that you can adapt? Are there areas to make yourself more risk-based? So that's one. Second is hiring. A large share of our model risk leaders were internal model development managers. Claire, one of my direct reports, PhD, statistics. For 5 years, she ran the small business credit underwriting models. And then she worked for 10 years before that at other firms. And so she's an excellent model validator and helps us think through our automation or our modernization process because she sat in the development seat for 5 years. Mary Grace, another manager under me, she was a consumer credit model developer for many years. And so I think it's important to step back about talent as well, is that you want a large share of your talent to have been people that were model developers at your firm. They've sat on the other side of the table. So many of the model risk associates on our team have previously received findings from model risk. So they know what it feels like. And they've sat on other tables saying, I've received findings from this organization. Now I'm in this organization. And so I think that helps. The more you can, in a healthy way, for career development is to hire people that came from model development internally. And then relatedly, when you export people around the bank, that they grew up in model risk too. So our head of data science, Chun Shiro's PhD, she was a model risk analyst who became a model risk manager, and now she runs data science. Daniel Stahl, our head of model and data platforms, he was a model validation analyst, became a model validation manager, and then he went there. Leaders in our strategic initiatives in ops and tech, Chris Kennedy, Aaron Bridgers, they used to be both of them were both deputy heads of model risk at different times. They're now in operations and technology. And so when our model governance analyst, Beth Hargrove, is now on the model governance side in fraud in the operations team. And so I think also exporting talent, then you can have these healthy relationships saying, we have a legacy model risk team, we want to automate it, we want to improve it, we want to modernize it. Can you help us? And for us, our 26 alumni, honestly, are the best, or some of the best. They say, yeah, I sat there and now I'm in the other seat. Here are some things you can do better. And it's coming from a place of love, because you help them move to the new role, you care about them, you fight for them for higher pay, you still mentor them. They're not trying to hurt you, they're trying to help you modernize. And then same thing with people you've hired that are coming from model development areas. It's coming from love. They say, I used to be a model developer. I used to get findings from you. I can't give academic findings and documentation findings and call them significant like you guys used to do 8 years ago. That's just not right. And so you hear their points of view and then you modernize based on that input both ways.
Absolutely. And I know we may have time for one more question. So Michael Fishbein, I hope I pronounced the name right. So have federal regulators started approving risk models using ML methods? For context, I'm thinking of the Basel framework. I know you've had multiple discussions about regulatory and other aspects, Jacob. So
I think the question, so regulators don't necessarily approve models. I've never seen that. Regulators assess the safety and soundness of financial institutions. And part of the safety and soundness is that, is there a strong third line internal audit? Is there a strong second line model risk? Is it effective? Does it have stature? When it gives findings, are they remediated timely and sustainably? Do model developers understand risk? Do model developers have a risk ownership and awareness? Or do model developers follow policy? Do they follow procedures? Do they follow templates? So, I guess one way you could ask the question as banks have used machine learning models and they've gone through model validation and they've gone into production, when federal regulators have examined those banks, yeah, I'm sure they've given findings or MRAs when they look sometimes on the model developers for issues, sometimes on model risk that they didn't have a broad enough aspect, they didn't test them well, or didn't test vendor machine learning models well, or didn't test fourth party machine learning models well, or didn't test financial crime machine learning models well, or they didn't count information security or customer authentication machine learning models as models, and therefore they weren't validated. And then you get an MRA for not quality of validation, but an MRA for not even doing a validation or not excluding them off your inventory. So I don't think that's, from my interactions, the regulators aren't necessarily quote unquote approving models. They're evaluating and holding banks to various policies. That's our 1519, that's our 11.7, and ensuring that model developers are adhering to the policies and the procedures of the firm, and then of course challenging the second line, challenging the adequacy of and the adherence to policy and procedures.
Perfect. So I think we are getting close to the 1 o'clock time, and we should wrap up now. But Jacob, this was a fascinating session. I learned so much whenever I speak to you and hear you. And this is all, the lessons from the trenches, right? So this is not, you sitting and looking at the beautiful ocean and cooking up, methodologies. This is tried and tested, battle-hardened methodologies which have evolved from best practices. And I can see the calluses in your, metaphorical hands, kind of, putting all these things together. But this is fascinating, and this is exactly what we need. And you kind of mentioned, take your model risk managers or your analysts to lunch. And literally, model risk analysts are hungry. Because they need the knowledge from the business side to make sure that they're kind of, understanding how the development happens. But it's also a dual-way street, right? So maybe we should think about like potlucks for development and the model risk managers, because the learning is on both sides, because a beautiful model without utility is absolutely useless. And all the business rules which cannot be operationalized is also going to be useless. But as the field evolves, I think these cross-pollinations and making sure that you understand not only the utility of these models, but also focusing on the engineering, focusing on the best practices, focusing on the enablement of the various stakeholders across the chain is an absolute necessity to make sure that, especially in a regulated industry like financial services, for the successful deployment of these models. And I think you have championed the cause, and all the materials you have shared with us is going to be of a lot of utility for both students who are learning and getting to know the field, but also for experienced professionals who are now asked to manage these models, which they hadn't even thought about a few months ago. So thank you again, Jacob, for sharing this abundant knowledge. And as you know, we are kind of building this series 1 week at a time. So next week we have another discussion on AI risk management. Jacob did introduce the concept in one of his slides, but we'll be doing a deep dive on AI risk management. That's going to be on March the 8th. And we have many more topics coming up. So please keep a watch on www.QuantUniversity.com for our upcoming courses and guest lecture sessions. So if you have signed up for this session, you will receive a copy of the video and the slides through Q Academy. And if you have any questions for Jacob, please do connect with him on LinkedIn, and we can continue the discussion online. Thank you again for your time, and we will see you soon. Take care. Bye-bye.
Thank you. Bye.